it now.
Here's my card.
The world of exchanges events, part one. We're going to do a part one and part two together, but there's way too much information, so we thought we'd break them apart. This one's going to be more of a high level, 30,000 foot view.
Thank you.
And we'll make kind of a quick fire question and answer. Try and get as much as we can in the next 30 minutes or so. DJ, if you could go to the next screen, please. Recognize our sponsors that made this all possible. CoStar, Kingsbarn, platinum sponsor, really appreciate it. Gold sponsors RPM Commercial Real Estate and First American Exchange. Silver sponsors Ely Commercial Asset Preservation, Incorporated. And special guest today, Gibraltar 1031 and Kingsbarn.
Can you guys all of the sponsors, can you raise your hands, please? Look at that.
And last but not least, our bronze sponsor, Business Finance Capital CDC. Thanks so much to all of our sponsors. We really appreciate it. Now, we start. Maybe the best place to start is a quick question. So, let me introduce you guys first. Cynthia Knowlton of 1031, Gibraltar 1031, Stephen Adams of Kingsbarn Real Estate Capital. We're lucky to have industry experts with us for these items. You know, especially with DSTs, they've been around for a long time. For some reason, they feel kind of like a new kind of vehicle still. So it's nice to be able to get some insight to that. And 1031s have always been a bit of a, I don't know, conundrum. People have a lot of questions about them. There's a lot of things that a lot of nuance. It's good to have experts that can kind of walk us through. So Cynthia, first and foremost, what is a 1031 exchange?
So 1031, actually 1031 is part of section 26 in the IRS code. So it's nothing that is a loophole. It is an actual 1031 code that allows an investor to defer their capital gains when they buy something of like kind that's going to be held for investment or used for a business or trade that is considered real property. So any type of real property transaction that is going to be disposed of, if they can replace it and transfer that basis and transfer all of those capital gains into a new property. So, and you know, it's a great way to diversify in real estate. So I might sell, there's a couple of retail experts in the room, I might sell a retail property and go into multifamily. I can change asset type, I can change location. Anywhere in the US is considered like kind. So it just gives me some diversity and some strategies for my investment portfolio.
And Steven, same question to you. DSTs, just a quick overview.
Yep. So DSTs are basically just fractional interest in large institutional assets. You get all the benefits of real estate that you're accustomed to. So you'll get monthly cash flow, you'll get appreciation on the sale. We typically hold them anywhere from 3 to 5 years, 5 years on average. And then you get depreciation benefits as well. We do a complementary cost segregation study, so you can accelerate that depreciation. But it's really 100% passive real estate investment that gives your investors access to institutional real estate, $30 to $100 million. And then going off of what Cynthia said, it's 1031 exchange eligible. All of our properties have a legal tax opinion in our document vault. And we've never had a single issue of not being deemed like-kind real estate.
Now, back to the question of like-kind. Would multifamily apartment building be considered the same as a retail property, as agriculture, as...
Yeah. So anything that's considered real property that's going to be held for investment, like a DST, or used for productive use in a business or trade. So if I'm a doctor and I own my own building and I own my own facility, that's something that's being used for productive use in business or trade. But when that doctor goes to retire, they can sell that building and still have an asset that's going to give them a return without getting out of the real estate market completely. So Things that don't qualify would be an interest in a partnership. And that's something that we have a lot of concerns about, especially here in California. So an interest in a partnership is not interest in real property, and it doesn't qualify for 1031 treatment. Your primary residence, you have exclusion 121, which gives you an exclusion of capital gains for 250,000 if you're single, 500,000 if you're married. So that doesn't qualify. But if you have a vacation home in Mammoth and you rent it out, that's a perfect example of a 1031 exchange. And if you had a multitude of properties that are single family and you wanted to sell them all and go out and buy a strip mall, you certainly could.
And if someone has a primary residence and they're thinking kind of long-term and say, well, we'd like to sell it in a couple of years, could they move somewhere else in the meantime and then rent that one out for a certain amount of time?
Absolutely. So they can qualify that property for at least 2 years as a rental property, as an investment. There are some extenuating rules now in 1031. So if you converted a property and then you sold it, you have a certain pro rata if you buy another investment and then you live in it first and then turn it into an investment property, or you buy it as an investment and then turn it into a primary residence, you're going to have a pro rata of that 121 exclusion. So no longer can you just preserve what came out of your single family, transfer to a new single family, rent it out for 2 years, live in it for 2 years, try to sell it and get your exclusion. It doesn't work like that anymore. So
Cynthia, can I ask a question
Sure.
along that line? So if you had a residence like that you were renting out, say, for 2 years, and then you did a sale to like your own LLC, say, and lease back to you personally, is that not allowed either?
not really, because if your LLC is a single asset, it's like you're buying it from yourself. And so, or at least it's considered a related party. There's a lot of rules. I won't go into all the related party rules. There's a lot of rules around related parties.
Okay.
And after you do a 1031 exchange, you're going to send in Schedule 8824. And so it's really important for everyone who's in this industry to just Google Schedule 8824, and then you'll see what an average taxpayer has to send to the IRS regarding their 1031 exchange. And it's going to ask if it's a related party transaction. So you don't want to be checking that box unless you understand all of the implications. So you can talk to your CPA about that.
Okay, thank you.
And one of the rules are the deadlines. People
Yeah.
get stuck on the 180-day rule, but that might not be the most important one, right?
So when you do a 1031 tax deferred exchange, you have two critical points in time, and those points start at the transfer of the property. Here in California, we have escrows. In other states, they don't necessarily utilize escrow. They have settlement agents and just transfer. So the date of transfer is considered the trigger. So if I transfer my property today, tomorrow's day one. I have 45 days to identify to the 1031 exchange qualified intermediary, which is what Gibraltar 1031 is. And then I have another 135 to close on it. So my entire exchange period is 180 days. It's not flexible. It includes weekends. It includes holidays. It's 180 days. And the first 45 is for the identification. And that's where Kingsbarn comes in, is that if we have a client who gets to day 40 and they're really having trouble identifying a property, a DST or Kingsbarn can certainly help them not fail that 1031 exchange. So identification is critical. And, you know, a lot of clients call me before they even list their property. That's the best time to start investigating what my capital gain situation is. It's the best time to go see my CPA and find out exactly what I'm going to owe in federal, state, and recapture of depreciation. So all three of those factors can add up to a significant amount for a 1031 exchange.
I've found that using a DST in a 1031 exchange very helpful, because you have those three properties you can identify, and you can put that third property as a DST, you know, kind of a break the glass scenario in case, you know, things go wrong in the other one. and it just provides a lot of peace of mind.
Exactly. I would say as far as for the DST industry, there's two sides of the spectrum with clients that I deal with. There's the ones that are 100% certain they want to go into a DST. So once they're non-contingent, we'll sit down with them. We'll build a portfolio allocation where they could go into one or multiple DSTs because they have the ability to diversify. And then from there, we'll reserve that equity for them. So once they close, the money goes from escrow to accommodator to Kingsbarn. 24 to 48 hours, their entire exchange is done. There's no lapse in cash flow. Those are for the people that know they want to go into a DST. For our investors that want to go into fee simple real estate, for instance, we're doing a deal with Greg right now. They're pretty dead set on fee simple, but as we know with the debt markets right now, getting different loans, sometimes things fall through. Whereas if you put the DST as say your third option on your ID sheet, it's at least a fail safe where you're in a cash flowing asset and you have a guaranteed close. Whereas if you put 3 fee simple deals, one sells, the other 2 don't pencil out, now you're stuck with, it could be $300,000-$400,000 capital gains, which is what we're trying to avoid, where they could at least park the month with us.
And in terms of that timing, if your clock started today, you sold your down leg today, you got 45 days. If someone calls you and say, hey, I may not go with the DST, but I want to put it as an option. Is there a fear that those 45 days are going to run out and that you'll be fully subscribed on that property, no one else can buy in?
It technically can happen. I mean, our deals typically fill up 1 to 3 months. The travel centers we have now, they're filling up in 1 to 3 weeks. If someone is using us as a backup, a lot of times we'll give them an offering. Like for instance, we have the corporate headquarters for Kim Kardashian's company Skims right on Hollywood and Vine. That was a $128 million raise. We're not going to do that overnight. That's something that is probably going to be around from now, probably till your 180th day of your exchange, pending any large investors coming in. That's something that we would feel comfortable having them ID as a backup. Whereas, the inventory that's turning over very quickly, there would be just open communication saying you could ID it, but we're not going to hold it for you. We're a backup to you. We can't save it for you. So it would be a communication with the client.
And once you buy into a DST, is there like a holding time that you can expect to be kind of locked in where you shouldn't be removing and just making a switch yet?
Yeah, so on the DST, if you read online, they're relatively illiquid. You're expected to stay from when you go into the asset until we do a disposition and sell the entire DST. Whereas at that point, there's another decision point. It's typically every 3 to 5 years where they could do another 1031 exchange. They could exchange it to a DST. They could go back to fee simple real estate, or they could cash out and pay the taxes. So those are really the options as far as hold period. We can facilitate a 1-for-1 swap with another investor. Say if you have $1 million in our program and emergency occurs where you need access to the capital, we could swap you out 1-for-1, but you'll sacrifice any appreciation because the DST didn't sell yet.
Like you mentioned capital. How does the finance component, because if you have a property financed and you're going to replace it, you have to replace the financing as well, right?
No, actually, it's one of the 1031 myths. So you do have to replace the value and you have to reinvest all of the net proceeds. You can offset debt with cash. Now, not a lot of people do that, and that's kind of where the misconception comes in because you have to replace the value. But if I sell an asset for $2 million and I have $1 million loan and I turn around and I want to put $2 million of cash into a DST, I can. So typically people don't do that just because, but sometimes if there's expensive financing, they'll pull money from somewhere else instead of getting new debt. So especially if I'm relinquishing a property with a 3% debt and I'm looking at paying an 8% debt, that makes sense. So it just really depends on the markets at the time.
And how does that work on the DST side?
So on the DST side, we have offerings that are free and clear. So for your clients that don't have any loans on the property, they don't want any more debt, they can go dollar for dollar into a DST. But I'd say about 75% of our DSTs have leverage on them, CMBS financing. It's typically around 50% loan to value. So they're able to come in, say if they have $1 million worth of equity, they automatically get assigned $1 million worth of non-recourse debt. It's off balance sheet financing. Kingsbarn guarantees the loan, but they're able to utilize that for 1031 exchange purposes. So they would have, say, a $2 million position in the deal. 1 million equity, 1 million debt. Now, if for some reason the client has more debt than equity, and that goes into a situation, if our deal's only at 50%, they have 1 million equity, 1 million debt, $2 million position, but they need, say, 2.2 million to satisfy their exchange. That's where they would have to come up with cash to meet that sale price requirement, or else they're going to get taxable boot where they're going to have to, pay some sort of capital gains. But we're trying to eliminate that and meet the complete sales price, so it just transfers over very clean.
That's a word you hear a lot in 1031 exchanges, boot. What exactly is boot?
So boot, excuse me, boot is anything that is not replaced in an exchange. So if I sell a property and I take cash out, that's going to be considered boot and it's going to be taxable. If I, for some reason, don't replace the value, but maybe I put all the proceeds in. So for example, I sell something for 2 million and I buy something for 1.7 million, right? Even though I'm putting all the proceeds in, I would be getting taxed on the difference of the sales price. So we do see that. And for some people, it makes sense to do a partial exchange. So as an accommodator, it's important to have somebody with knowledge and just an understanding of what the client's goals are to make sure we can get them into the right position. So we are considered an accommodator, but our official title is a qualified intermediary. So people call us accommodators, facilitators, and you absolutely have to have a qualified intermediary to do a 1031 exchange. So our role is to make sure that you don't have any constructive receipt of the cash, or that you aren't controlling the cash throughout the transaction. So it's important that we get set up prior to the close. If the property closes, the relinquished property, the sale, and they didn't have a 1031 set up, they can't go back and set it up. Even if they left the money in escrow. If the escrow is in their name or the closing is in their name and they had access to those funds, it's boot.
That was
It's
my next
taxable.
question.
So you have to make sure your accommodator set up. And a lot of people say, Cynthia, I'm not sure I want to go with the DST. I'm not sure if I want to go with be simple. What are my options? And, basically setting up an exchange is like setting up an insurance policy. It's going to buy them an additional 45 days to make a decision on whether they want to go into a fee simple deal, a DST, or just pay their tax. But if they didn't set it up, there's no turning back.
And it's a pretty inexpensive insurance policy.
It is.
Compared to what you could.
Very inexpensive compared to a taxable event, especially if you weren't aware. For some reason, people certain times a year have trouble connecting with their CPAs and really getting their bottom line as to what it's going to cost them when they sell this property. They forget about recapture of depreciation. That's 25% of all the depreciation taken over the years of the property. So that can be a significant number for someone who's on long-term.
And then just to touch on, I think another common misconception that we see is just, because every time I'm working with investors, they'll say, they'll be like, I have $1 million with my accommodator. I say, well, is it free and clear? Do you have debt? And they'll say it's free and clear. And then they'll send me their closing statement and they'll say, well, I paid off the loan. I don't have to, I paid it off in the closing statement. Why do I? But a lot of them fail to realize you have to replace both equity and debt. And that could, run us into some last minute issues when I don't have the numbers matched because they said it's free and clear. And then they show me their closing statement and there's, $1 million in debt. And I'm like, you're going to take a pretty big tax hit if you don't replace that. So
You can't offset that with that.
exactly.
Yeah.
So you can't decide to do a 1031 after closing.
Correct.
What is a reverse 1031?
So reverse 1031 really is a fantastic vehicle. They became codified in September of the year 2000, and it's 2000-37. And it allows a client to purchase a replacement property first. So it's taking the mystery out of it. A lot of clients say, well, I don't want to list my property because I'm not sure if I can replace it with something that I'm happy with. A reverse exchange allows them to acquire that property first. So there are some complications. It is a more expensive transaction because we're setting up a special purpose entity. And basically we're going to hold that property in an LLC until they go back and sell the relinquished property. It still has timelines. It still has 180 days. So we set up what's called an exchange accommodation title holder. And we set up the special purpose entity and acquire the property with their funds, okay? And close on the property. Once we close on that property, they have 180 days to go back and sell the relinquished property. So they have 45 days after we acquire the property and put it into this parking arrangement for them to identify what their relinquished property or properties are. Often a reverse exchange is used when you want to consolidate. So if I have 3 different assets that might be selling with 3 different timelines, I'm not sure I can pool them all together and get all those funds with the qualified intermediary prior to finding the new property. This way I can allocate what I'm going to spend from the 3 properties, acquire the new property, and then go back and transfer the funds from each one into it. Okay. So there's many different types of exchanges. People don't even understand the construction exchanges and build suits and different improvement exchanges. Not all of them are doable because of the timeline constraints, but oftentimes you can solve a lot of problems, especially for value add guys. The improvement exchange is invaluable.
I've heard, I'm sorry.
Please describe how that improvement exchange works.
You know what, I don't know what our time situation is. So let us go ahead, and I'm happy to stay after and go through all the parameters, but I want to make sure we have enough time to go through the nuances of the DST as well.
Did have a question about DSTs. I know that some DST companies, firms are not allowed to pay commissions, but your company doesn't have that issue, right?
So that's our niche in the industry. There's typically through DSTs, it's through broker dealers, financial advisors that source deals from different sponsors. They're approved on their platform where they can then take investors in. What's proprietary about Kingsbarn is we work directly with real estate brokers. Everything that we do, we manage in-house. So we actually close on the assets with our own funds, and then we raise the equity ourselves through 1031 exchanges or sideline. So that's the main difference there. Is Kingsbarn is a direct sponsor, whereas the other broker dealer channel is they're sourcing other sponsors' deals, and we're able to pay brokers a commission on that. So it's just a different way that we raise capital.
Is that in any state?
So it's specifically structured to California, as far as a California real estate broker and a California resident, but the property could be located anywhere throughout the country.
Are you seeing trends from office to retail in the exchange? As far as going on right now, we're seeing a lot of heavy activity.
I just closed on a sizable transaction, a multi-tenant office building that my client had been managing for 40 years and was absolutely done with the management, and just bought a brand new retail center in Florida. You should ask. Well,
That's about it.
So yeah, he's very happy with this brand new asset. It's a little bit different of a tenant management relationship for him.
And are you seeing a lot with the like standalone restaurants being traded quite often?
No.
Okay.
No, I don't see a lot of that. So retail is very popular right now. I don't know what you're seeing, but retail is popular. And
the biggest thing we're seeing in our industry is just apartment owners in the city of Los Angeles being fed up with the legislation, their hands tied as being landlords. A lot of them are at a wealth preservation age where they can no longer deal with the tenants and the headaches that come with being able to evict and get them out of certain situations. So those are our main investors right now, is moving from active management to something passive like a DST, or even looking at, fee simple triple nets, quick service restaurants, things of that sort.
I like that wealth preservation age.
Yeah.
So I have another question. On average, I know it's different for each DST, but usually the biggest selling point for me used to be you'd have a guaranteed income check every month, without fail, and then you get the appreciation when you sold out of the asset. So on average, how much is that these days?
So on average, it's a 6.5% cash on cash return. We have some deals right now in the high 5s and then some in the 8s. I would say, it is still real estate. Kingsbarn does not guarantee the monthly income. It's only as strong as the tenant and the lease that's in place. So if anyone tells you that, the money's guaranteed, I would, run the other way, because there are circumstances like COVID with the office market, vacancies fall. There's certain clauses with the lenders. These are designed to be safe and secure, but, we had situations we were discussing with Walgreens where the credit rating dropped, people that, these really are class A institutional assets, but, it's just like any other real estate. It's not perfect.
I think it's a great spot to go ahead and let me do the presentation.
Yeah, I'll jump on real quick. I got some slides. It's moved through pretty quickly. And I want to make it as informational as possible. So you guys could stop me at any point if you have. Did you have a question, by the way? I saw you raise your hand.
It's sort of an interesting question. Basically, it revolves around economic problems in New York and California, where some of our aggressive politicians are saying, we're going to tax the rich.
Yeah.
We're going to tax the billionaires.
Mhm.
And it's obvious to me they're going to be looking at any transactions where they can penetrate and tax real estate transactions.
Yeah.
Is 1031 exchanges exempt from the laws that are now being enacted to tax the rich?
Are you referring to the mansion tax that's in place as far as?
Any of the taxes.
I mean, they're still going to.
So the taxes usually, during the escrow period, at the closing, the taxes get paid. So most of the time, that's not something it's going to be cost of sale, because they couldn't sell that building without paying that tax. So it's not something it's going to lower what the replacement value has to be of the replacement property. It doesn't change the 1031. The 1031 is a federal tax code, but what it does is it takes the municipalities and the local legislation. It takes the tax from the sale, and then you move on.
Okay.
With your.
So basically, 1031 exchanges are exempt from
I wouldn't use that
some
term.
certain amount
I
of.
wouldn't use that term. They're not. The 1031 is independent of that local tax. That's how I would, because the local tax is going to be in place, and then you're going to see the exchange from there.
I think, correct me if I'm wrong, so you have your sales price, but then you also have commissions, you have closing costs. So say if you sold your house for 2.5 million and you eliminate those closing costs, those commissions, now you might have 2.4 million, and then you get rid of the taxes. Now you might only have to replace 2 million, but you're still technically paying the tax.
So certain closing costs are cost of sale. Certain closing costs may not be cost of sale. So if they're cost of sale, they can be excluded from the 1031. They don't have to be replaced. But if they're cost of, let's say you have defeasance, which you're paying off because you had a CMBS mortgage, and you've got to pay defeasance. Defeasance is not cost of sale. It's cost of repayment of your money. So you can't take that expense off of a 1031. It may be considered food. So there's a lot of little nuances, but.
Thank you for the explanation.
Sure. Yeah, we could click. Is there a way I can click through it, or are you controlling it from over there?
Oh, no, you just need to ask,
I'll
our
just say
admin.
next slide.
Next slide.
Yeah, we'll do the next slide. Perfect. So this is just what we're going to cover. We'll go over, Kingsbarn Real Estate Capitals, just about what a DST is, the benefits to investors, the benefits to brokers, how we're able to pay you, some case studies, and then we'll go over some of our current offerings. What if you had an investor today, what they could potentially invest in. Next slide. Okay, so about Kingsbarn Real Estate Capital. Kingsbarn's been doing real estate syndications for the past 35 years. We've never lost a single investor dollar, and we've never broken even on a sale. So we've always been able to give you back your principal and some level of appreciation. We're in 28 states throughout the country. So for your investors that are looking to get out of California real estate, I have a handful of them. There's opportunities in other states. And then we also do have an offering in California as well for your investors that like to see, feel, and touch their real estate. We've grown to just over $2 billion worth of assets under management. And our average return is right around that 6% cash on cash, which is net to your investors. Next slide.
Next slide, DJ.
So Kingsbarn, what we do is we handle everything from start to finish. So we have an acquisitions team. Our headquarters is out of Las Vegas, Nevada. We have about 90 employees there. They go out, they source the real estate, and then Kingsbarn closes on it with our own funds. And then we backfill the equity through 1031 exchanges or sideline capital. So when you're coming into this deal, it's not a true syndication where we're using all the investors' money to purchase the deal. We already own the asset. It's already cash flowing. So once you come in, you're automatically participating in the cash flow from that property based on your pro rata share of the investment. Next. This is just our executive team. Our CEO is led by a gentleman named Jeff Pori. We pulled over a handful of executives from BlackRock. We have a development arm as well, led by a gentleman named Phil Mader. A lot of our DSTs, we do the ground up development on. With a lot of our TAs, we're purchasing existing sites and doing extensive renovations. We recently closed on Griffin Towers in Santa Ana. That was a fire sale to us from Blackstone. We got it at a 13% cap on current. We're currently doing, it was a private placement, getting the vacancy up and then planning on putting that into our DST program. So we're not just a DST company. We also have other offerings as well for clients that are looking to solve more for an equity multiple or an IRR, a little bit of a longer hold period, but those aren't 1031 exchange eligible. Next slide. About DST. So as I discussed in the Q&A, it's just fractional interest in large institutional assets. You get all the benefits of real estate that your clients are accustomed to: monthly cash flow, appreciation, depreciation. They get a monthly operating statement. At the end of the year, they get that full tax package. The accounting work's already done for them. It is 100% passive. And that is the biggest objection I get dealing with landlords and apartment owners in California is, they're turning they've worked 20 years to build this equity and now they're giving it to someone to make decisions on their behalf. It's a bit of a learning curve. As you guys alluded to, the DST isn't very known about. It really started in 2011. It was an adaptation of the TIC, the tenant in common structure, which a lot of people, those deals went sideways. The main difference there is that with the DST, the loan is non-recourse. So the investors aren't liable for the loan. The voting rights, Kingsbarn has full voting rights. And then there's no capital calls with the DST. So if your investor puts $1 million in, that's the maximum amount that they can. We can't reach out to each investor and say, hey, we need $10,000, $20,000 for improvements. Next slide. So we give out all the clients access to our document vault. Basically, all the due diligence items that we use to close on the property, we upload into a portal where they could share that link with their broker, their financial advisor, their CPA, just so they could have a team looking at the information to determine if this is, the right deal for them. Each offering has a private placement memorandum, which is basically the Bible for each specific offering. It has the appraisal, the phase one, the zoning, the property insurance, everything that you would use to close on a property is already conveniently located for you in one simple location. Next slide.
Can I ask a question?
Yep.
Is there a minimum that you guys accept to come into a DST? Say we have a broker has client with a small commercial building, maybe multifamily or something.
So there's no SEC requirement as far as a minimum. We like to see 250,000 as the minimum, just so these deals we don't have hundreds of investors with 20 to 30,000. But there are also a lot of times where clients will buy a fee simple deal. They'll have 2.5 in their exchange, but the deal only covered 2 million, and so they don't get stuck with boom. They'll say, can we put the 500 grand into the DST? And we'll take that. I've had some investors, they sold a bunch of condos and they were getting 150 grand here, 200 grand, and we'll work with you. It's just, we don't want thousands of people coming in with,
Sure.
very little amount. So it's about 250.
Thank you.
And then this is just a chart here showing how the DST industry has grown. As mentioned, we kind of call it the silver tsunami. There's a huge transfer of wealth happening right now from wealth preservation age until their kids, where they no longer want to deal with active management. They've built such a high level of appreciation in their properties. A lot of our investors purchased them in the 70s, 80s, 90s. They don't want to pay capital gains, but they can no longer manage it. Their kids don't want anything to do with the real estate. They just want cash. So that's where we're seeing an uptick in investors coming into the DST and transitioning from active management. Next slide. So the benefits to real estate brokers. I'd say the biggest thing here is that we're not only used as a 1031 exchange option, I like being utilized on the front end as well, because as we see with people that are looking for a reverse exchange, one of the biggest objections that brokers get when they're trying to list a property is, well, what am I going to exchange into? There's nothing out there. I don't know what I want to do. We could work with your client on the front end to put together a portfolio allocation, take their equity and debt, show them that they're going to get, a 6.5% return. This is the annual, this is the monthly that you're going to get each month. And sometimes it helps brokers actually get a listing because they feel comfortable that there's something that they can exchange into that's going to continue to cash flow for them. But as I mentioned, you get paid 3% on the equity invested. We could close in as quick as 24 to 48 hours. So you could get your up leg done with. You could focus on getting more listings and, focusing on your asset class and the location you work. Next slide. This is just the basis for compensation. I know you had asked a question on how we're able to pay brokers. This is the exact section of the Securities and Exchange Commission that allows us to legally compensate brokers. You can take a picture and go through at your own leisure. We have a in-house attorney as well that, if any of your brokerages, they have any questions about if we're fully compliant, they could speak, their language, and I'm more than happy to make an introduction. Next slide. So who's the right fit for a DST? It's really for anyone that's looking to get out of active management. They no longer want to deal with tenants, toilets, trash, taxes, things of that sort that all come with, owning fee simple real estate, especially for landlords, as I mentioned in LA with the legislation. They're looking to defer their capital gains. They want a monthly return, but they don't want to deal with the headaches of sole ownership. Yes, sir.
Can your DST ownership be used as collateral for a bank loan?
It can. I have done that for some investors where they want to, you're saying, take a loan out against their DST?
Yes.
They can't do that. No, they can't use their interest in the DST for a bank loan. They could use it as a proof of funds to qualify for a loan, but they can't directly borrow against the DST.
In other words, the value of their DST ownership, let's say they give you $50 million. Yep. If it was in a regular bank, you could borrow probably up to 50% of that.
Yep.
But if it's with your firm, you can't borrow against that $50 million in equity?
No, because of how it's structured in the Delaware Statutory Trust. They're a beneficiary of the trust that owns the real estate. So they're not able to directly borrow against it, but they could, again, use it as to show in their,
Okay, what happens if there's an emergency in the family and of the $50 million, they need a distribution of $5 million immediately from you?
Exactly.
Can you do it?
Yes. So what we do is we put it in writing with them. If an emergency occurs or they need access to the capital, we would sell their shares. So say if they needed $5 million out of the offering, we could replace that with another investor penalty free. They'll be subject to capital gains tax if they take that out, if they don't replace it.
Okay.
But it's going to, they'll also sacrifice any appreciation because the DST didn't sell. So it'd be, really an emergency type situation, but we have done that for certain investors.
Great. That's great.
Yeah. Next slide. Benefits to real estate investors, again, certainty of closing. They meet their 45-day identification period. They get to defer their capital gains tax, and then they get all the benefits of real estate. We'll move along here. Next slide. This is just something Cynthia could look at as well, as far as doing a 1031 exchange and not utilizing it. I would say, what percentage do you think is capital? 35, 40%?
Yeah, I mean, again, it depends on how long they've held the property, and obviously the longer the hold period, the higher the capital gain percentage. But for most people in California, it's a minimum of 28%. By the time you just click off, state, fed, and any little minuscule repayment of depreciation.
Of course, I like to show this to investors because a lot of times they say, well, why don't I just put my money in treasury bills? It'll pay me, 4%, and I could just, it's the safest investment. Well, you're getting 4%, but you're giving up $500,000 worth of equity by not doing a 1031 exchange and keeping it in real estate. So now you're getting, 6% on $1 million rather than 4% on 500,000. For you to make up that money back, it's going to take years.
And one thing I want to throw in is we still have, these step up in basis. And as long as the federal government doesn't change building and I give up 30%, it's gone, right? It's 30%. In a 1031 exchange. And if they don't want to manage it, you now have an answer for that. But in a 1031 exchange, they're preserving that 30%. And if it's structured properly, when it passes to their heirs, the heirs get the step up in basis. They don't have to pay back that 30%. It's an amazing transfer of wealth vehicle. And it's not a loophole. It's perfectly legal.
Swap until you drop. is what
Yeah.
it is. Keep 1031 exchange it, leave it to someone else. Next
Yeah.
slide.
I'm looking to be adopted. I'm just saying.
This is just a success story about a client that came in. They were dealing with, they had a portfolio of apartment buildings. They were looking to get out of active management. They were able to diversify amongst multiple DSTs. As I mentioned, you don't have to put, if you have $1 million, you don't have to put into one. You can put 250,000 across 4. Now you have a diversified institutional level portfolio. You're in different asset classes. You're in different states throughout the US, and you're able to build a portfolio much easier than if you were trying to tie up different properties at different times. Be simple through a 1031 exchange. Next slide. We can skip through this one. We'll go to the next one. Just another example of a client that came into our program. This is just going to show how quick from call to close that we could do the DST. Sitting in a meeting like this, if one of you had an investor or were looking to invest in one of our DSTs, as quickly as 24 to 48 hours later, if money's with the accommodator, we've worked directly with Cynthia. Our closing team would have direct communication. It would be a transfer of DocuSigns, purchase and sales agreement, and you could be in the DST as quick as tomorrow or the next day, and you start accruing interest immediately. So, say if today's the 14th of May, you get a prorated check the first week of June for your time in the deal from the day you close. So your interest starts happening immediately. A lot of clients like that because, these are mom and pop type owners, even though LA views them as the big bad landlord. A lot of them need this income to survive and pay their bills, where they might not be able to go 180 days looking for a new property without any cash flow. So they like here, they start getting income immediately and they can cover whatever bills, expenses they have. Next slide. Okay, and now we'll just go through our current offerings. Next slide. So this was the office in Hollywood, right on Hollywood and Vine. It's the Skims corporate headquarters, Kim Kardashian's company. They just got valued at $5 billion. They plan on going public this year. They partnered with the NBA and Nike. It's really started out as women's shapewear, but it's really transitioned to an athleisure brand like Lululemon and Fiore. They occupy 98% of their property. It's basically a single tenant office deal. The other 2% is City National Bank. Starts out at a 6.5% cash on cash return and has 3.75% annual increases. So it'll go up from 6.5, 6.75, 7%. And that's net to the investor after all fees. There's no fees for coming into our program. So if your investor has $1 million with the accommodator, they'd be getting $65,000 a year on that $1 million paid out in monthly distributions. Our fees are already baked in to the return that's advertised there. Next slide. So this is we bought a portfolio of Tesla sales and service centers. This one is in Lake Elmo, Minnesota. This one starts at a 5.17% cash on cash return, brand new 15-year lease, 2.5% annual increases, and it's backed by Tesla Corporate, the 10th largest company in the world per market capitalization. Of course, it's a little polarizing with Elon Musk. A lot of LA investors didn't want to touch this, but at the end of the day, in the next 3 to 5 years, do we see Tesla going completely out of business? No, it's a very strong tenant. The odds of them not being able to pay their lease and keep this operational are very slim. This is one of our very conservative type offerings. Next slide.
Only 2% annual increases.
It's like if you get a Starbucks or a Chipotle, they know who they are, up there. At least the return is in the high fives. I've seen a lot of Starbucks, Chipotles in the fours right now. So
Next slide, please.
yeah,
DJ.
next slide. This is just another Tesla that we have. We bought a portfolio of them. So we've been doing a handful of travel centers of America, TAs, if you've ever seen them on a road trip. The big three in the industry are Pilots, which Warren Buffett just bought the last 1/3 share of. You have Loves, which is private. Then you have TA, which was bought by British Petroleum 2 years ago for just under $2 billion. We're doing the ground up development on these, or we're purchasing existing sites and extensively renovating them. The tenant's coming in with a brand new 20-year absolute triple net lease, and these have 2.5% annual increases. These start at an 8.5% return, and these are the deals that, if someone was looking to use this as a backup, these ones are filling up very quickly. Whereas, say, the Hollywood building, $168 million, that's where I'd feel more comfortable someone IDing as a true backup. But these have CAT scales, they have laundry facilities, overnight parking. About 90% of the income is guaranteed through fleet accounts, where they have contracts with their companies where the truck drivers have to stop at specific TA locations. They're all strategically placed by TA corporate based on the demand from their truck drivers delivering freight throughout the country. So we've done 17 of these. They've all been very successful. Next slide.
Can I ask a quick
Yeah.
question? So if you wanted to buy into something like this, you need to wait until the lease starts and pay rent, correct? Or
Anytime that we make it available to our investors, it's already cash flowing, it's already closed on. So by the time you come in, you're automatically just picking up your cash flow based on your program share. Yep. This is another TA we have coming in Lincoln, Alabama. Same tenant, same lease terms, 20 years, 2.5% annual increases. Some of these have equity. This one's projected to have no debt. So this would satisfy your clients that are free and clear and don't want to take on any new loans. Next slide.
So this brings another question to mind, because I work with Muslim investors who can have interest, right?
Yep.
So would this qualify for them?
As far as debt, no debt. Yes, that would be free and clear. So whatever equity they put in the deal, that's what they would be getting their cash flow off. And then when we sold the asset, they would have no loan to replace, so they could take their principal back tax free. They would just be, have subject to capital gains on whatever the appreciation is, and they could 1031 exchange that. And then this is just a recap of what we covered. Kind of a broad overview of the DST, our program. You can go to the next slide. These are questions that I get asked frequently. So how am I protected when I introduce my client to Kingsbarn? You send us a fee agreement that links you to that client in our database. If they invest, you get paid a 3% fee. If we sell the asset and they reinvest with Kingsbarn, you get another 3% fee based on now it's their principal plus appreciation. If they refer me, their brother, their cousin, once they're in the DST, they want everyone to go in DST. So I'll get calls from their friends. And if they refer me someone, I'll pay you a fee again. So it's, I come from the brokerage community. I was with Marcus and Millichap, sold apartments. So we really value the relationships with brokers, and we want to keep you guys compensated. So you keep bringing us potential investors. 3% based on the equity is the fee. It's not just for investors in 1031 exchanges. You could use sideline cash. Is a DST like a TIC? We went over the differences there. And does Kingsbarn offer multifamily? The yields are relatively compressed on there. We're in just about every other asset class except multifamily. The closest thing we have is student housing. But other than that, we're in retail, industrial, office, those asset classes. Next slide. That's our AI guy. I don't like him. I'd rather you just call me. So, they're trying to take our jobs, You can skip that. You don't need a picture of that.
Let's put a big X on
Yeah,
it.
put an X on it. And then you take a picture of that one. That's fine. They got AI everywhere trying to replace us.
quick question. So if you wanted to get out of your position in the DST, you're just selling the shares, right? And you're replacing them with other capital.
Yeah, so you can look at it in that circumstance as like a stock transaction, but it's not going to happen as quickly as a stock transaction. There's going to be, we like to say, give us, 30 to 90 days, just as if you were selling a property and went through, an escrow, for us to make sure we could find someone, replace it, and get you out. It's not going to be like you log on to Fidelity, sell your shares, someone else comes in and you have the money. So we do tell our investors expect to stay through the lifetime of the asset, the 3 to 5 years. But if an emergency arises, medical expenses, we'll do what we can to facilitate the swap.
Thank you.
What if we have a situation where we're in a 1031, we picked up the up leg, but we're short a little bit. We got an extra 150K.
Mhm.
Could we reach out to you even though it's below the 250?
Yeah, that's where I'd say I work with, especially, brokers have, brought me deals and it's a solution for their client, or they're really not in a position to pay capital gains tax. We'll work with them. We'll take it. It's just a matter of, we don't want to advertise that we'll do that, because then people start trying to give us a little amount. But yeah, we'll definitely take, under the amount to help someone satisfy their exchange.
I think you touched on it briefly. What sort of reporting do you provide for investors? I think you said monthly at a certain point.
Yeah, so it's a monthly operating statement, a tax package at the end of the year, the cost segregation studies in the tax package, so they could turn that over to their CPA to file it accordingly. And then we have an in-house CPA as well, where they could speak the same language as far as how they want to utilize their depreciation. They could still choose to straight line, 39-year depreciation, or they could utilize the cost segregation study and under, the big beautiful bill, 100% bonus depreciation year one. But hopefully they keep exchanging, or else they're going to get hit with, big recapture. So it depends on their financial situation and their own goals on how they utilize that information.
Gotcha. And what on the monthly report, is that similar to what you would get on like a quarterly statement on something that is like SEC regulated, or is that regulating guidelines like also apply to you guys in terms of reporting requirements?
Exactly. It's very similar to the quarterly. It's just basically the property's performance. If there's no real changes to it, it's kind of vague as far as, what's going on. But at the end of the year, they get the full income statement and everything that, all the profit and loss statement for the company.
Okay.
I wanted to ask, are there any questions from our online audience? DJ, is there anybody who has something in the chat?
You only have Henry here.
Oh, okay, got it. Hi, Henry. Anybody else? Any other questions?
This might be a Jeff Corey question, but are you guys looking into investing in data centers?
And that would be a Jeff question. Everything goes through him as far as acquisitions. I mostly deal with it once it's, on a platter and I can serve it up to investors. I don't deal too much as far as our acquisition criteria, but I'm more than happy to, if you have a card, we could get you guys in touch. Seems like you might know him.
So that was my next question, because a lot of us work with developers. So what are you guys targeting in terms of your next projects, and how can we help you with that?
Of course. So on a scale from my knowledge of what the acquisition criteria is, everything we do is Class A, corporate backed guaranteed leases, nothing less than 15 years remaining on term. The typical deal size is $30 to $100 million. That's what we'll use in our DST platform, because it has to be fully stabilized. We can't do any value add in the DST program. As far as the private placement side, what they're looking at, we did in Mauna Kea, we bought 14 lots in Hawaii. We partnered with Shohei Ohtani on that one. We brought in a lot of Japanese investor money through that private placement. So we're very agnostic when it comes to, asset class. We're opportunistic as far as what we'll look at. So if there's anything, we bought land and developed apartments on it. So that side of the company is a little bit different than my focus. But if you have something that you think we would like, you can reach out to me and I can put you in touch with Phil, the acquisitions team, and they can see if they like any of the deals.
I want to commend both of you for doing an outstanding presentation.
Well, thank you, sir.
I would like to present DST and your company to some of my clients, but the best way to do that is if you could send your slides to Alec,
I got him. We got
Betsy
him.
Moriarty, and then she can forward to all the attendees here at this seminar. We're in a better position to help you with our clients.
I appreciate that. Thank you.
And we offer consultation to all clients. In fact, it's almost preferred that we do a consultation. 1031s aren't right for everybody. And sometimes if somebody just recently inherited a property, they may not even know they got to step up in basis and they don't need to do a 1031 exchange. So consultations are extremely important. And there's no expectation from the customer. So
It's my assessment that after we present your services to our clients, then the consultations will occur.
Thank you, Stephen. That's pretty much it. I want to thank you all. We're a little over time. I want to thank you all for coming out. We really appreciate it. Hopefully it was informative.
I think we have, yeah, chapter announcements. We've got.
We got a few more.
Next slide, okay? Awesome.
Yes, we got a few classes coming up. CI 101, financial analysis. We've got Connect LA coming up May 28th.
And the
And
Deal
Deal
Makers Award. So if anybody here has done a deal or did a deal last year that they are especially proud of, our chapter is going to be accepting, there's a form, of course, accepting, submissions of these deals, and then we'll choose an award winner, which will then go on to be at our fall forum, which is here in LA this fall. And that winner will be judged with other chapter winners too. So it's really, I'm hopeful that everybody will submit their deals.
Next slide, please, TJ. Broker Forum, June 18th. We had a really good turnout last time at Ely. And Hearth and Hope Day. That was a really nice event we did last year where it was families that were affected by the fires. And we put together a room for them, whether it was a bedroom, furniture stuff, or whether it was a dining room or a living room. And it was very interesting. I attended, a lot of us attended. I think a lot of us got more out of it than what we thought we were. It was really amazing. And I encourage you guys, if you're available that day, to check it out.
Plus, it was kind of like a game show where you've got, like an hour to stage and pick out, furnishings that all go together. And then it was super heartwarming to see the families come in. These stories are really, I'm tearing up now. We had some people who teared up then too. It was really, really wonderful. So please join us. That's a Saturday. I apologize, but we were trying to do Friday, and they said that the families who were helping can't get out of work. So I understand that. So we're doing it on a Saturday.
You'll appreciate going.
Yeah.
Next slide, please, TJ. And now it's a big thank you to all. And for hosting it today. We really appreciate it.
This was great. Thank you so much.
Who needs validation, but didn't valet? But okay. Let me be there. Not a lot. High volume. Happy to, give you my 2 cents for whatever.
He was convinced he wanted to be simple. Days before his ID period ended, he said, "I don't like this